Hello friends, welcome to Institute of Banking Excellence. Today we are going to talk about restructuring. Before starting the video, if you like it, please press the like button, share and subscribe it with your friends. Without wasting much time, let's get started. Early identification and reporting of stress. Information to CRILCS. The information is to be submitted by lenders for account having exposure of Rs 5 crore and above on monthly basis. The lenders shall submit information on weekly basis for accounts which goes in default by close of business. The accounts are to be reported as SMA depending upon overdue status of repayment. Principal or interest payment or any other amount wholly or partly overdue between 1 to 30 days is subcategorized as SMA 0. Principal or interest payment or any other amount wholly or partly overdue between 31 to 60 days is subcategorized as SMA 1. Principal or interest payment or any other amount wholly or partly overdue between 61 to 90 days is subcategorized as SMA 2. For credit facilities of revolving nature like cash credit, the SMA subcategories will be as follows. Outstanding balance remains continuously in excess of the sanctioned limit or drawing power, whichever is lower, for a period of 31 to 60 days is subcategorized as SMA 1. Outstanding balance remains continuously in excess of the sanctioned limit or drawing power, whichever is lower, for a period of 61 to 90 days is subcategorized as SMA 2. Resolution plan. The lender shall undertake prima facie review of borrower account within 30 days of such default as reported by any of the lenders. This period of 30 days is also called review period. The lenders agreeing 75% by value, fund-based plus non-fund-based, and 60% by number shall enter into intercreditor agreement. Resolutions under RP1. Resolution under the scheme can be with or without restructuring. If restructuring takes place, account to be immediately downgraded into NPA. Upgradation of account can be upgraded if it demonstrates satisfactory performance during period from implementation of RP up to date on which at least 10% of the principal debt and interest capitalization stands paid. Further, the account cannot be upgraded before completion of 1 year from commencement of first payment of interest or principal, whichever is later, on credit facility with longest period of moratorium. However, if exposure is above Rs 1 billion at the time of RP implementation, credit facilities of the borrower shall be rated at BBB- or above at the time of upgrade. If exposure exceeds Rs 5 billion, 2 ratings are required. Resolutions under RP2. Additional finance under RP, to be treated as standard provided account demonstrates satisfactory performance during the monitoring period. Conversion of principal into debt, equity and unpaid interest into funded interest term loan. The instruments created out of pre-restructured facilities will be kept in same classification as the credit facility. Resolutions under RP3. Provisioning and valuation. The provisioning is applicable to the credit asset category. The provisioning based on their fair value. Equity instruments shall be quoted at market value if listed, and lower of book value, on the basis of last audited annual results of the company which shall not be more than 18 months old. If audited results are older than 18 months, the shares will be valued at Rupee 1. Equity instruments classified as NPA will be valued at Rupee 1 only. Preference shares to be valued as per discounted cash flow method. Revaluation reserves for the purpose of valuation are not to be considered. Conditions for implementation of RP. A. RPs involving change in ownership. If exposure is above Rs 1 billion, credit rating to be above RP4 for entity to be eligible for resolution. If exposure is more than Rs 5 billion, then 2 ratings would be required. B. RP without change in ownership. First, if there is no restructuring, shall be deemed to be implemented as on 180th day from the end of review period, if borrower is not in default with any of the lenders. Any default after 180th day will be treated as fresh default and would require fresh RP. Second, if there is restructuring, A. all documents/securities perfection etc. is completed by all lenders. B. New capital structure and/or changes in terms and conditions of the existing loans gets fully reflected in the books of all the lenders and borrowers and C. Borrower is not in default with any of the lenders. C. Delay in implementation of resolution plan. If not implemented within timeline as given above, the lenders will make additional provisions, over and above the provisions already held at the time of RP, as under. If not implemented with 180 days additional provision 20%. If not implemented within 365 days 15% in addition to 20% that is total 35%. This is it for this video. Thank you so much for your love and support. Stay tuned for the next one. Till then, bye and stay blessed.